Someone was calling us out. You talk about homes, but you don't talk about the numbers. You say just buy a home. Well, here we go. Two scenarios, 0 down and 20% down. Now let's assume you're here on a 4-year billet because a lot of people get orders to Hawaii. $800,000 purchase price for both.
The national average of holding a mortgage loan is about 3.7 years.
The people that we would recommend to not buy, I could have refied. So for you guys who think we're just being optimistic, we're going to get to the negative. You're going to be taking a loss.
A lot of parts of the island that had already recovered.
They get in Hawaii with like, so what? And what? So I'm here with special guest, Jodie Tonga, Pacific Rim Mortgage. Jodie's our business partner, a friend. She crushes VA loans, really just lending on the whole island. In the comment section, people ask her, hey, can you go over the numbers for VA loans? Someone was calling us out saying like, hey, you talk about homes, but you don't talk about the numbers. Like, it's not fair. You say just buy a home. Well, here we go. So we're going to get negative towards the end. But we're just going to show you the 4-year outlook because a lot of people get orders to Hawaii. Maybe they're in the military. This is the 4-year outlook that most people explain. And Jodie and her team ran the numbers for us. Two scenarios, 0 down and 20% down. So the 0 down is with a VA loan. It would be a little different if it were a 3% FHA. A USDA is a whole different thing. $800,000 purchase price for both. What is the interest rate that you ran these at, Jodie?
5.49.
That's today's rate. There's options here, right? Like a 7-year ARM, 5-year ARM. Like you could do those things here, but we didn't run those. It would get too convoluted if we did all of that today, right? But if you do a consult with Jodie or with us, like when we have these conversations, we'll go over these things.
We'll definitely talk about the 2-1 if we do a consult because that's like the hottest thing right now.
So at the time the video is published, that's the timely hot thing, right?
Right, yeah.
Yeah. This video will be evergreen. The ARM will always be a thing. And 2 years from now, interest rates will be different anyways. We're going to talk about that later. But so $800,000 purchase price. If you put 0 down at today's rate, approximately 5.5, $5,000 a month, $4,200 a month had you put the 20% down.
Yeah.
I'm actually surprised the disparity is not greater. The conventional interest rate's higher, right?
It's higher, but it's not as higher as it was before.
The delta isn't as big as it was. Okay.
Yeah.
So you can see $5,000 a month, $4,200 a month. Now let's assume you're here on a 4-year billet. You know, you're here coming to Coast Guard, the service that I was in, Navy, Air Force, Army, Space, or whatever it is. You come for 4 years.
The other reason that 4 years is kind of cool, a cool span to think about, is because the national average of holding a mortgage loan is about 3.7 years.
Before they refi.
Before a refi.
Okay, so that's your world, because I was like 3.7. The average for moving is like 7 to 9 in the realtor world.
Right. Yeah, so we're not talking about moving.
Okay.
We're talking about how long are you actually going to have this loan that you close when you buy the house. So
that interest rate.
At that interest rate.
Less than 4 years.
That's the national average. So
okay, I didn't know that. One fact. Okay, so 4 years. What happened in those 4 years? You just don't even make your extra payments and put your tax returns into your home, do all the fancy stuff. Just make your minimum payments. You will have paid down approximately, a lot of these numbers are approximations, rounding to the nearest thousand, approximate $46,000 that you've paid down on that $800,000 home. If you go conventional, it's 33. What is the home's new value 4 years later if you assume a 4% annual appreciation? I see loan officers especially say, like, well, 4.5, and some people say...
We use 5, some people use 7.
You can't count on this, and we're going to get to that. So for you guys who think we're just being optimistic, we're going to get to the negative, case scenario. If you assume a 4% annual appreciation over that 4-year span, your home is now worth $935,000. How much equity have you built through forced equity, which is paying the home down, and through appreciation, which is just existing in it and not destroying it? $181,000 increase for PCS'ing here and buying a home rather than living in the economy.
And that's 0 down.
How much did you put into this? 0. So if we're thinking about going and buying a rental property, a multifamily, investing in stock, buying a car to do Turo, any investment, one of the metrics people use is cash on cash return. At what rate do I get my initial investment back? You ever watch Shark Tank?
Yeah.
You know, the like Mr. Wonderful always, Kevin O'Leary always puts the same deal forward.
Yeah.
It's always like, I want to give you the initial 100 grand. You're going to pay me like $5 for every teddy bear that you sell until I get my 100 grand back. So he's always looking at how quickly do I get my initial investment back, because at that point he has essentially zero risk, right?
Right.
So how quickly do you get your initial investment back here is different than here. Here you had no investment, you have an increase, so your return is infinite. In the investing world, we call that an infinite return.
It's the opportunity of a lifetime.
You helped me buy my home with a VA loan. Now, granted, I bought it off market, didn't get my commission, etc., but I bought it for $725. At the peak of everything, it was flirting with $1 million, like well into the nines, and right now it's probably worth $900,000. So my scenario is, in less than 4 years, is similar to this.
Yeah.
My return on my investment is infinite. If you were to put 20% down, so this is good for two reasons. People watch our channel and they watch every video and absorb the whole catalog. So there are going to be people who are 20% down people watching this. To Jodie's point, it demonstrates the benefit that is the VA loan, where you can get infinite returns. These people had to make an initial down payment of $160,000 approximately. They forced $168,000 in equity through paying down $33,000 and also through the 4% annual appreciation. These homes are worth the same. This person had to pay $160,000 to get into this situation. This person paid zero. You can do internal rate of return, cash on cash. Capitalization rate is something for commercial investments. One way to look at the ROI, one way, is they're getting a 25% return per year. Their $160,000 is returned to them in 4 years. That's 25% every year. If I could give you a 25% a year stock right now, you'd say bet the farm, right?
Right.
Veterans can get an infinite return. So most lenders and lenders I won't work with, etc., real estate agents, you should always buy. You should always buy. Fact is, they're usually right. It's not that everyone is good or everyone's great at this craft. It's that we live in Hawaii.
It's a unique market.
The most beautiful beaches,
Limited space.
nice people, cool food. Like none of this is going out of style.
Yeah.
The military doesn't seem to be leaving.
No.
I wish someone had got to me when I was an E4 and I said, you should buy. And I was like, nah, no, you don't know what you're talking about. I would have made a ton of money if I did.
Yeah.
So let's say that things went bad.
All right, guys. So common questions people give us all the time. Is it too early for me to look? It's not. Make sure you click the link below to check out our website, fill out the contact form, let us know your timeline, and let's connect soon.
So our bad case scenario.
So we're just talking about if this doesn't happen, this 4% appreciation, what are your options going to be if you have to leave?
Yeah, you're PCSing. Hey, I got out of the military, I'm going to go get Maui or whatever the case, but you're not exiting this property. You're not selling for these large profit margins at the 4-year mark.
So here's the conversation. I am upside down and the realtor just told me I can't sell unless I do something called a short sale, which is when you sell for less than you owe on the property, which is not good for your credit. So it'll be like, well, remember when we talked about like way back before you bought the property and we were talking about all the different scenarios that could occur? We'll revisit this scenario because that's what we're going to be saying. Yeah. So we're going to say, you don't have to sell. We want you to hold the property. Yeah. But this is what it's going to cost you.
So let's forecast it. Like you're going to be taking loss. You're going to be taking a loss. Now, we're being totally negative here. We're not mentioning the tax benefits, et cetera, of being a homeowner. There are more benefits where we're staying negative. So if you bought in 2008, the market crashed in Hawaii. When did the market return? It was like 2000. By 2014, I don't know that you could really find a neighborhood or a large area where the homes hadn't at least reached equilibrium, if not started to appreciate.
There's actually a lot of parts of the island that had already recovered.
Manoa is just so desired. People, it's hardly gonna take a hit.
Right.
You know, Nu'uanu.
Right.
Go to Kailua, like these places are different than say Eva that took a greater hit. And this $800,000 single family is more likely to be an Eva.
Yeah.
And now let me say that too. This is a single family home because notice we didn't add maintenance fees and other fees that don't go towards your equity, paying down your home. Instead of the additional 2 years, it was 2008 to 2014, 6 years, we said let's hold it till 2018. So you're like way more profitable and probably looking more like this. So for an additional 4-year hold at a loss. So when we're writing this, I said, Jodie, what do you like? Do you feel cautiously optimistic that we'll see 4% rates again
Yeah.
in the next 4 years? These 4 years, is someone probably going to get to refi closer to 4%?
Yes.
Anything could happen. Nothing's guaranteed, but
Once inflation gets under control, interest rates will start to come down.
all right. So an additional 4-year hold, refi at 4%. Your new payment, $4,200.
Yep.
And that's on this one. If you refi this one, your payment will go way down. You might even cash flow. This is a way better for exiting in the month-to-month rent. But this is referencing the VA loan. So $4,200 from $5,000 went down to $4,200. Rent potential right now, an $800,000 home in Ella, single family. Probably rent around $3,500 a month, depending on the home. With rent increases, because you get it to $4,000 a month over time, probably. Let's stay negative. Let's assume the $3,500 per month. $700 a month at a loss. 2 years, that'd be $1,700.
17,000.
Or sorry, 17. Mahi walked in and I looked at it and I lost it up. Hey, messing me up. So at 2 years, $17,000 lost.
Loss. So you're spending $700 out of pocket
Every
to make sure that you can make your complete mortgage payment. So you're taking the $3,500 rents and then your own money, your own income, you're paying an additional $700 to make sure that you can pay the $4,200 mortgage. That's a negative in that time.
But you're working to get back to this or more.
Right.
$700 a month loss doesn't count the tax savings average throughout the year. Doesn't count the pay down. You're paying it down for yourself and for your family.
Right.
Like, this is unfairly negative, but we just wanted to be that for you. So worst case, if you could let me pay $34,000 right now to have this kind of potential outcome and probable outcome in Hawaii eventually.
And what would you be doing with that $700 if you didn't spend it here? I know there's better places to spend $700. Like, you don't want to be like, awesome, we're negative on our mortgage.
No.
Where is that $700 going?
No offense, person watching this. I would argue that most of us don't know of a better place to spend $700 when you...
That's my point. When I got my first house, it was like, okay, I was paying the mortgage payment and then living my life, right?
Yeah.
And it was like, oh, how can I afford that? Then I got my second house. And I was like, man, there's no way I'm going to be able to afford this. So my first house, I was at a negative rent. And then my second house, I had, the new mortgage. So then I was like, man, there's no way. But then, of course, right, I'm making the mortgage payment with help of a little bit of rent, and then living my life. My point is, like, you're going to figure it out. And now I have these assets that continue to grow. And sure, there was a little bit of a pause in 2008, but now since then have continued to grow. And now that's equity. I mean, that's what I found.
Because you'll have to sell it now. You can leverage it. Like, say I come to you, Jodie, I want to flip this house. I need $200,000. I'll give you back $300. It's going to take 6 months. You're like, well, I can leverage my house. Like, you have an asset.
Yeah.
So $17,000 at a 2-year hold, $25,000 at 3, $34,000 at 4 years. That's how much that deficit between new payment and rent, so much that deficit is going to cost you to hold. So there's a cost to be in an investment. So you didn't put $160,000 down like these people did to try and achieve a return. You were at zero, but now you're going to have to start putting some of your own money to invest in this probable eventual outcome, right?
Yeah.
So at the end, you should have but eventually, history would tell you in Hawaii, now, I don't know, could like a nuclear war happen and we're the first to be taken out, like barring something like that, or the American dollar going to nothing, like,
Yeah.
barring something like that, history will tell you in Hawaii, you get to these sorts of situations. If right now, you could tell me, Derek, give me $34,000, but in 4 years, even $100,000 in multifamily investments. So when you go, we pull our monies in these big multifamilies. They call that an equity multiple. So if you invest 50, you double your money, usually at 5 years. That's the underwriting. You put nothing down to get into this. 4 years and $34,000 of pain to do this. It makes me question my multifamily investments. I should just do this as much as I possibly can. assuming I can make it through. So who are the people that can't make it through?
Yeah.
If you are an E6 testing for E7 and you feel good like you're going to make it and you just got here, usually when you make E7, they move you. And so now you have to exit at 1 year. If your wife, your husband, your partner is a physician or, makes good money, whatever the case, and you can stick through this situation anyways, well, it's a forced savings account, it's a forced investment, maybe you should buy it. But in general, if people are going to be here a year, Jodie and I both say no. Who else should not buy? I think an E4, whether they're married and their wife makes money or not, or their husband makes money, like a young E4 who's like, when I leave here, I'm going to get out and use the GI Bill.
Yeah.
A lot of people do that. So wait, you're not going to have a job? You're not going to have income? You have no interest in staying in Hawaii. I went back to Texas where my GI Bill is only going to pay $1,000 a month. They're like, it'll be a calculated risk. So if this works out, that E4 is leaving the Coast Guard at 24 years old with 6 figures, potentially multiple 6 figures, it may work. If it doesn't work out, they're leaving, they can't afford this. Now they're going to work up a short sale or foreclose or something along those lines. So those are the first two I think of. If you're testing for promotion and you're going to leave right away, so short time on island, and or you're going to get out and go use the GI Bill and not have much income, don't buy.
The flip side to that argument is if you are E7 and you are financially sound and you did study the market or you listen to Core Team Hawaii and you feel confident that investing in Hawaii is going to be better than where you're going to be somewhere else where you're going to see much lower to little appreciation rates, then getting that asset in Hawaii
For $0.
for $0 versus like, okay, well, so this happens all the time. I'm not using my VA because I'm waiting until I retire so I can go use my VA in Texas where you're going to buy a mansion for $400,000. You could have done 0 on an $800,000 purchase and then on the side been saving up for your 5% down and go conventional on the VA in Texas.
Fair point. I didn't think about that.
So we actually coached a young couple, dual military, and they knew they were going to Virginia. And we sat here in this very room and this is over 10 years ago, we did so many numbers and they bought in Sea Country. When they got moved, they were like, well, it could be 1 year, it could be 3 years. Like, we don't know because they were dual military. Yeah. And one of them was an officer. So long story short, we crunched the numbers and they were like, we believe in Hawaii as our investment. This is like our investment. So we're going to go to Virginia. And what they did was in the 3 years that they stayed 2 years. So they couldn't sell Sea Country.
Yeah.
There was no way for them to sell. I got that phone call where they were like, we're upside down, we can't sell.
Let me interject though. The military, so for the VA loan side, not so much conventional, for the military cannot go about during financial crises having 30% of their workforce losing their security clearance.
Right.
This is a thought exercise. I'm not telling you to bank on this, but I'm telling you to be educated and be aware. If 2008 were happening in tomorrow, which I don't think we're primed for that. Too many people put too much down. Too many people are locked into 2% and 3% loans. They can afford to stay in their homes. They have to protect their nest eggs. But if something bad were to happen tomorrow, some financial crises, the government usually develops these bailout programs. Homes for heroes, bailouts for heroes. They have to, because they need to give military members, especially active duty, a way out, keep their security clearance, protect their workforce. So if you had to do a short sale,
right, then you
fix your credit, potentially buy again in 2 years. Should you bank on these things? No, but what, love or hate Donald Trump, knowing the financial and the tax system, he's saying, well, risk to benefit ratio or risk to reward ratio, reward in just 4 years could be this. Even if I have the additional 4 year staying power, is almost probably this, almost definitely this. Risk, I short sale, I rent for 2 years. I would have rented anyways for 4 years. Repair my credit, repair my finances, and buy again and time it better the next time. I don't want to be so salesy, but it's just the truth.
It's just the numbers.
It's just the numbers. I bought at the peak of the stock market. You helped me buy it. If I had to let go of that property and lick my wounds, I'm still buying real estate for the next 10 years as much as I can, because that's my retirement.
What other, I know it's so salesy, but where else can you put in $0 and then walk away with a potentially 181,000, and that's at 4.
That's at, and at 4 years, if things go bad, you gotta pay a little. I mean, if I came right now to you, active duty member, and I said, hey, I'm forcing $700 into your TSP.
Yeah.
No questions. It's not your option. I'm doing it.
Yeah.
You figure it out. You make life work. So if this happens, you figure it out. This is the eventual outcome. Not almost definitely. Let's say that person in 2008 held until 2021.
Yeah.
They made more in a 10 to 12 year period than they made in their entire military career.
Yeah.
Probably.
Yes.
Especially base pay. And depending on where you were stationed, right? Like, if this person bought in 2010 when the market was down and held until 2021, like they made more in one investment, one vehicle than in their whole military career.
Yeah.
The reward is so high. The risk is there. The market could go down. And what? Like in Hawaii, we're like, and so what? And what?
Right. It's not a horrible bad case scenario. Ultimately, 4 years later, you get to walk away with net proceeds of more than 181,000 because you've been paying down your mortgage all just 4 years.
Yeah, this would be 4 years bigger, and it would be more than 46,000 because the way that it would probably be what, like 55, 60, another 60.
Yeah, like 100K.
100K, yeah. It'd be bigger than this. Long story short, Monopoly, Cash Flow 101, these games, you buy real estate, you wait. The people that we would recommend to not buy, gonna promote and leave, don't have the financial staying power, don't have the interest in Hawaii. Outside of that, if you have interest in Hawaii long term, or even just like your clients, a belief and a confidence in Hawaii long term, even if you're indifferent to Hawaii, if you have a confidence in its housing market long term, and you have the staying power, I don't see why not. Like if you can, you must, right?
I mean, you really should. I mean, we're just using the numbers to provide as much information as possible. The reason I decided to get into mortgage is because I knew I wanted to buy. Isn't that kind of the reason you started getting into?
I also would be an investor. I sold a business and I was like, where do I put this 25? I didn't sell it for much. It was a lot to me though. To the time, I got 24,000. It was a lot to me, and I wondered how can I grow it. It was in the Bay Area. I could have done this probably 3 times in a 10-year span because I could have bought, I could have refied. I could have bought, I could have been in the Bay. So I joined the Coast Guard because I'm in Hawaii. I'm like chasing girls, whatever. I'm going to join the Coast Guard.
Yeah.
Met my wife right before I joined, like put my life together. So I joined the Coast Guard, get out, become an X-ray tech, make good money, get a couple of degrees, business degree. So I come home to Hawaii 14 years later. I feel very accomplished.
Rightfully so.
And then I would meet people and they'd be, yeah, bro, I'm like, you remember my uncle got me into construction and because I bought one house when I was 22 and frick, bro, I learned how to pay them off faster. I paid it off. And now we get 2 more. So I get 3 houses, 2's paid off. And I was like, you bought what? You did what? And I was like, you never went to school. No, this is the Hawaii story, right?
Right.
My uncle got me in. I didn't overthink it like Derek.
Yeah.
I bought real estate. I put money towards it. I waited. I bought more and I bought more. So yeah, me and my wife, we get a couple paid off. We think we're retiring early. And I was like,
The power of the leverage, the power of the asset.
so for the Dave Ramsey years, Dave uses leverage. Dave is sophisticated, but he's speaking to every person in America, every person in the world, and what he does, very, very conservative, will work. Save your money, be tight, have no debt. If you have debt that produces this,
Smart.
that's what they say good debt. When people say like college loans are good debt, I beg to differ. I just told you the story about how they did me no good. This sort of leverage or debt that gives you this potential or probable eventual outcome is the kind of debt, in my opinion, good debt.
Yeah. And even this.
34,000. Like, I guarantee you we can go back, like 90+% of the people watching this, we can trace back the last decade and find 34,000 that would have been better suited for this situation plus. And if, like we said, if they held into a 2021 situation.
If you are real with yourself and you go through your bank statements for the past 90 days, you can find $700. And so if that's our bad case scenario and you have, access to this loan with 0 down, of course, conventional is going to make sense too, but the deficit's going to be smaller also for conventional. But my point is like
They might cash flow in this situation. They might be they're probably cash flowing.
after the refi, so it's going to be way less of a loss because remember you did what
return.
Yeah, it's a lower return, of course, from zero. I mean, you can't compete with zero down. When you are real with yourself and looking through your finances and figuring out what you're spending your money on and really understanding how you can find $700, you can find it.
You can find it. And which you're like, bro, you guys sound entitled. You guys, well, if you're buying at the $300,000 level, these numbers all become smaller. So you have to find 700, maybe find 250 or whatever the case may be. Here's my last analogy and we'll hang it up. Trying to outsave the market the Ramsey way is like being next to a rushing river and trying to run. Buying real estate and waiting is like jumping in that river, using its inertia and momentum and paddling. Why not do that?
That's great. I like that.
I never said that before.
I've never heard it.
That's what it is.
So yeah, the Dave Ramsey is not going to be a horrible outcome in 20 years. It's not going to be a horrible outcome. You're not going to be broke in 20 years.
By the way, Dave makes money off of real estate agents. And so he's like, you should buy. You should always buy. He's probably more like bullish and just telling people to buy than I am. Hope you enjoyed this video. I'm sure people can poke holes in this. So they can be like, you didn't account for GE tax having to be paid on this income when you go with it. There's all sorts of things you could poke in this. This is pretty general and broad. Book an appointment. Go to our website. It's in the description. Join our Facebook group, all that. But also leave your comments. Leave your scrutinizing or positive or negative or just confused comments. Leave them all. We'll adjust them in a future video.
Oh, that's all right.
How you doing?
Mountain behind us. And then
Connected with Derek, and Derek was able to help us sell my mom's childhood
I
home.
thought it was a great investment, which it is.
We had a great buying experience.
Very new to Hawaii. We met Derek and Mahe through their YouTube channel.
I'm in the Army, and Megan is a certified nurse.
Hi, I'm Nab.
And I'm Rachel, and we're going to be selling our Waikele home.
I work very heavily with Core Team Hawaii.
We bought a house from Core Team Hawaii here in Honolulu.
Even though we are here and we live here now, we own a home here, we still watch your videos. Yeah.